Welcome everyone to today's video in which we're going to take a look at The Honest Company, ticker symbol HNST, a company that has become very popular amongst the retail community, mainly because one financial channel, which has almost 1 million subscribers, has recommended buying it a lot. And if we take a look at the stock price, it has been a roller coaster. The stock IPO'd at $19 per share in 2021 and then fell to $1 per share, so a 95% downside. Then the stock jumped to $8 per share, so a more than a 600% upside. And then another fall from $8 per share to $2.47 per share today, so around a 70% drop. A lot of this volatility is due that the company is a small cap. As you can see, the market cap is $276 million, and last year they made $383 million in revenue. Now, very quickly, if you don't know what The Honest Company does, let's quickly take a look at the revenue by segment. They basically sell wipes, personal care, and diapers. As you can see, 50% of the revenue comes from wipes and personal care, 30% from diapers, and 20% the other. So they sell sustainable products that have clean ingredients, and I've personally never used their products, so let me know if you have in the comments. But on Amazon, it seems like they do pretty good. As you can see here, 4.7 stars and 8K reviews, 7.6K reviews, 43.9K reviews, and 4.5 stars. So it looks like their products are liked. However, if we take a look at the revenue, this is not by any means a fast-growing company. I mean, in the past 6 or 7 years, they have grown from $235 million to $383 million. However, some years they've even have declining revenue, and the revenue is a bit inconsistent. As you can see here, for 2 years they grew at almost double-digit revenue growth, and last year they grew at 3.8%. Now, if we take a look at the quarterly revenue, last quarter, revenue fell by 6.7%. And therefore, I believe it is very important that in the next quarterly earnings, which is in like 20 days, they show positive revenue growth. Now, let's take a look at the profit. Let's switch to the annual chart. And as you can see here, this company turned profitability very recently, and they are currently generating $7 million in net income. Free cash flow is negative at the moment, which is something that I don't really want to see. So let's hope that in the next couple of quarters, they turn this free cash flow into positive. Now, their margins, as we have mentioned, this company recently turned profitability. So they're currently making 1.8% in profit margin. However, their gross margin is around 38%, which is very good and has been improving. Now, companies that usually have a gross margin around 38% in the beauty sector, I would say have margins around 10%. A negative aspect about this company is the number of shares outstanding. As you can see, they have been increasing the number of shares outstanding by a lot. I mean, last year they increased it by 14%. This is horrible for investors because you share the profits with more people and you own a less percentage of the company with the same shares. And while it is true that young companies tend to do this in order to raise more money, this has to be backed by growth. And at the moment, The Honest Company is not growing very fast. Now, on the other hand, a very positive aspect about this company is the balance sheet. They have $71 million in cash and only $11 million in debt. This is tons of cash, especially for a company that we have seen has a market cap of $276 million. So one could argue that the company is actually cheaper because of that amount of cash. And before we look at the valuation, which is always the most important aspect about valuing a stock, if you want access to stockanalysis.com, you have my code in the description. It is where I have shown all the charts and data in this video. The valuation ratios don't tell us anything at the moment because this company is still very young in terms of profit. So this is why the P is 40, the forward P is 16. The price to free cash flow is not available as they are not generating any free cash flow. The price to sales is 0.7. Now this does look cheap, but in order to take a deeper look at the valuation, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $1.8 per share, middle 3.4, and high 5.5. Now, because the stock is currently trading at $2.5 per share, this means that if my low assumptions occur, you would get a 4.5% annual return on your money, middle 15.5%, and high 25.5%. So I would say the company looks slightly undervalued according to my assumptions, in which I have The Honest Company growing revenue between 2 and 6%, annually over the next 7 years, averaging a profit margin and free cash flow margin between 4 and 8%, and I assigned a PM price to free cash flow at the end of the 7 years of 14, 16, and 18. Now, the issue with this company is that I believe there is a lot of unknown about future revenues and profit, and it is very hard to determine. For example, if we take a look at the financial forecast, analysts are actually expecting a 9% annual revenue decrease this year, and then 7% growth, so a bit all over the place. And then in terms of EPS, from 6 cents per share to 7 cents per share. There are not a lot of analysts covering this stock, but if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. And in conclusion, I believe the honest company is just very hard to predict, and it's a bit of a gamble. I mean, we don't really know whether future profits and revenue are going to be in the future, and while it does look slightly undervalued, if I'm going to buy a small cap company, I wouldn't want a lot more than 15 or 20% returns. So in conclusion, I believe there are just better opportunities in the market that are a lot safer options. For example, I've been buying companies such as PayPal or Adobe, which you have videos in the channel in case you want to check out. And I think, for example, these companies are number one, more undervalued than the honest company, and number two, a lot easier to predict and a lot more established. So, I mean, the company could easily go to 8, maybe, but it could also go lower. It's just a bit of a gamble for me at the moment. I will say that a huge positive is the balance sheet, but then we have negatives such as the decline in revenue growth in the last quarter and the share dilution. I hope you found this video valuable. Let me know what you think about the honest company in the comments, and I'll see you in the next one.